Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I'm excited to be here with all of you. And it's been raining cats and dogs in South Florida for this past 4 days. So I can't wait for the rain to go away so I can go to the beach with my family and enjoy whatever is left of the summer. But again, duty calls, so I'm here with each and every one of you. Today, this is actually episode number 84. So we're fast approaching 100 episodes. As you know, we host one of these events every single week. And as you all know, I do webinars and podcasts and seminars. And it's all about providing financial education because at the end of the day, information without education always leads to failure. Now, we had, this is the last part actually of a 7-part series that I call Understanding Your Financial Paradigms in Retirement. And this last episode of this series is going to be dealing with long-term care. And long-term care is one of the major issues and concerns that all of us are going to have to deal with at some point in time in the future. And I would imagine that many of you know of someone that is now going through long-term care, perhaps a family member, perhaps a close family member like a parent or whatever that may be. But at the end is something that we're going to have to, all of us are going to have to deal with because of the fact that we're living a lot longer today than we've ever had before. And the longer that we live, the more the susceptibility we're going to have for long-term care. So we're going to be discussing the effects of long-term care in retirement, talk a little bit about Medicaid spend-down rules. We'll also share some information on community spouse rules if you happen to be married and one of you has a need for long-term care. We'll discuss 4 major alternatives to protect yourself and your family from any long-term care need. And then we'll figure out what the right option for you may be. So obviously every one of you is different, so the options may vary. But let's start with the effects of long-term care in retirement. And there are many, many of them. Obviously, it can have a really bad negative impact not only yourself, but also on the caretaker and the rest of your family. But I think it would be very prudent for us to address the old paradigm, the old way of thinking versus a new paradigm and the new way of thinking. In the old paradigm, this is how most Americans thought of long-term care. Medicare will cover long-term care. Assets could be gifted away in order to qualify for Medicaid. Children could take care of aging parents. I'm not going to need long-term care in the future. Or they would even have the attitude that there are only 3 ways to mitigate long-term care risk. You can either self-insure, pay for it yourself. You can rely on family members to do the caring on your behalf, or you can buy expensive long-term care insurance. So that's a way that it used to be, and it was actually like that for many, many years. I think the question is, well, what is a new paradigm and the new way of understanding long-term care in the United States? Number one, the national long-term care averages are anywhere between $6,700 to $7,500 per month. That's a tremendous amount of money. That's a tremendous amount of cost. And it's actually increasing by anywhere between 6 and 8% every single year. Can you imagine if you have to pay for this care? It can deplete your retirement assets very, very quickly, and we'll have a discussion on that along those lines as well. Another thing that is going to be very critical for all of us to understand is that 70% of retirees will need long-term care. Medicare does not cover long-term care, and this is something that Most Americans don't really know. They think that once they reach the age of 65 and they apply and get accepted for Medicare, that if they happen to have a long-term care need, that Medicare is going to cover that, and the answer is not. Medicare does not cover long-term care. Well, many Americans think then, well, how about Medicaid? Well, Medicaid pretty much only steps in when you're broke. When you are totally broke, that is the only time that Medicaid is going to step in. Another thing is, many people think, well, perhaps I can start gifting my assets away and then I can qualify for Medicaid. Well, it used to be a lot easier, several years ago. But now the Medicaid look-back period is 60 months. So unless you were able to gift away your assets more than 5 years ago, then you're not going to be able to qualify for Medicaid, because whatever assets you gifted away within a 6 year or 60 within a 5 year or 60-month period, then Medicaid is going to bring the value of those assets back into the equation, and that is more than likely going to prevent you or someone in that scenario to qualify for Medicaid. The other thing that is very critical to understand and to consider is that long-term care can destroy a lifetime of savings in as little as 7 years. Now, in the old paradigm, you say, well, perhaps my kids can take care of us. But I think what you will find under the new paradigm is that life gets in the way. So children are often incapable, actually many times they're resentful, of taking the long-term care duties. And the reason for that is quite simple. If you have to take care of an aging parent or an aging brother and sister, and you're the person that has to provide the care, then you need to place your life on hold until that person no longer needs long-term care or is no longer with us. So most children, because of the fact that they're raising their own families, remember, we happen to be the sandwich generation, which means, we may very well find ourselves taking care of our children while at the same time we're taking care of our parents. So that's something to consider, because kids, for the most part, they don't want to have to provide for those long-term care duties, especially as you go through the different stages of long-term care. And obviously, one of the good things is that expensive long-term care insurance is no longer the only way to safeguard from a long-term care event, and we'll spend a little bit of time on that as well. Now, I think obviously we've talked a little bit about Medicaid and the fact that the look-back period is now 60 months or 5 years. And the fact that the only time that Medicaid is going to come in and help is if you are literally financially broke from a business standpoint. Now, what are some of the Medicaid spend down rules that all of us need to be aware of? I would argue number one is a joint federal and state program. So every state has Medicaid rules, so you have to be careful in the state that you live in. Some states are a little bit more, they're a little bit better than others when it comes to their Medicaid rules, but always bear in mind that it is a jointly program between the federal government and the state government. The asset qualifications, and this is on the average, every state may be a little bit different, but the asset qualifications is you need the person that is going to qualify for Medicaid needs to have approximately $2,400 of countable assets, and that's it. So if you were planning for a really wealthy or a very successful retirement, unless you're able to get rid of those assets 5 years prior to having a need for long-term care, then you're definitely not going to qualify for Medicaid because of the how strict the spend down rules truly are. Now, what happens if you're a community spouse and you're married to someone that has a need to long-term care? Well, that's where the community spouse rules come into play from a business perspective. Now, in community spouse rules, the community spouse can maintain about $121,000. It's $120,900 to be exact of assets. So if the husband is the one that has a need for long-term care, the spouse and the wife can have $120,900 of assets. They can keep one house and they can keep one car. So if you happen to be a community spouse, you again can maintain $120,900 of assets. You can have one house and one car. Now, in addition to that, you can have what is known as a minimum monthly maintenance needs allowance. That's a pretty long name for that, which it's approximately $2,500 in most states when it comes to what you can get on a monthly basis in order to maintain the non-LTC spouse standard of living moving forward while he or she is taking care of the other person. So again, as you can see, the Medicaid rules for the vast majority of Americans are going to be very, very difficult to qualify for. Now, for those of you that may have a pension benefit, if you have a pension benefit from a private company or a public company, if you happen to have worked for the federal government or the state government or a municipality, there's a very high probability that you're never going to qualify for Medicaid because of the fact that you do have Social Security benefits, and then on top of that, you may have pension benefits which are guaranteed for life. So therefore, that's going to prevent you and your family from qualifying for Medicaid. Now, which is the right option for you? And obviously there are many different ways. Now, some people may say, well, I'm just going to pay for it myself. I guess if you're wealthy enough, you may be able to pay for that yourself. But that's something that is going to be critical to understand as well, because you don't know how long you're going to live. You don't know what kind of expenses you're going to have to incur. And what if you spend the majority of your assets to take care of yourself because of your long-term care needs, and then you pass away? You know, what's going to be left for the surviving spouse? Is he or she going to have enough money where they're not going to run out of money before they run out of life? So these are things that are going to be very, very critical and very important to take a look at and plan for. And the sooner you can start the planning process, the better off you're going to be. I mean, obviously, if you're going to retire at 65, try not to plan this at 64. You know, you should be planning for this 5 to 10 years earlier. Number one, it's going to be cheaper. Number two, you're going to have a lot more leverage. And number three, you're going to be able to make the right choices because of your health conditions at the point in time that you apply for, you know, any of the different options that may be available. Now, for many, many years, the only thing that you could have done was purchase traditional long-term care. And just to kind of give you a little bit of idea as to how traditional long-term care works, obviously, when you purchase a traditional long-term care policy, the underwriting process is based on morbidity, not mortality. So therefore, if you have joint and back issues, that may disqualify you from obtaining long-term care insurance. Another thing that is important to understand is, well, how do you qualify for long-term care? And there's something called the activities of daily living, and there's 6 of them. And if you cannot perform 2 of those 6 activities of daily living, then legally you can qualify for long-term care. Obviously, you're going to need a letter from a physician that will qualify and will certify that you cannot perform 2 of those activities of daily living. And the 6 activities of daily living are eating, bathing, dressing, toileting, transferring, and last but not least, continence. So if you cannot perform two of those, then you would qualify for long-term care benefits. Another issue that traditional long-term care policies bring to the table is that premiums are not guaranteed, and they may also rise in the future. As a matter of fact, many insurance companies that used to sell long-term care insurance are totally out of the market today. And the remaining companies, every 2 to 3 years, they continue to increase the premium on long-term care policies that were sold in the past, because of the fact that long-term care is such a new phenomenon that is very, very difficult to price, because there's not sufficient experience to determine what would be the right pricing ratio from an insurance component standpoint. Now, the coverage for traditional long-term care is typically use it or lose it. So if you purchase a long-term care policy at the age of 55 and you die in your sleep at the age of 85, 99.9% of the time, all that premium that you paid and the opportunity cost of what you could have done with that premium, it just goes away. Nobody recovers any of that. So therefore, the opportunity cost on the premium and the internal rate of return that you could have received on that premium, because of the fact that you died in your sleep, never needing long-term care insurance, is not something that you're going to be able to recover. So that is one of the major issues that Americans are facing when it comes to purchasing traditional long-term care policies. And then last but not least, expenses under long-term care policies are paid through reimbursement. So you have to send a bill in for the expenses that you incurred on a given month, and then the insurance company will take a look at that billing, will determine what's suitable, what's not, what's reimbursable, what is not, and then obviously they'll send a check to the caretaker or to yourself in order to offset those expenses. So that's pretty much how traditional long-term care has worked. And it has worked for many, many years, and they're still available in the marketplace. For some of you, it may be a suitable option. For others, it may not. But again, that's the old paradigm. Now, the new paradigm offers different ways of taking care of long-term care needs or protecting yourself and your family from a long-term care challenge by purchasing a life insurance policy, which is what I call a 7702 plan, and using that as an approach to mitigate long-term care needs. Why? Because if you buy a 7702 plan with a long-term care rider or a critical illness rider, it will actually double, not only as a death benefit but also as a long-term care benefit as well. And this is fairly a new phenomenon, so I'm going to spend a few minutes on this, and then we'll close out the podcast for today. But the big difference between the traditional long-term care that we just covered and the 7702 plan approach is that in the 7702 plan approach, the underwriting process is mortality versus morbidity. So even if you have joint and back issues, they're not a problem. Now, obviously, if you have a heart condition, or if you had a stroke, or if you had cancer in the last 2 to 3 years, then you may very well not qualify for either traditional long-term care or the 7702 plan approach to long-term care protection because of the fact that you would be uninsurable. But if you're otherwise healthy, but you have joint and back issues, then that would not prevent you from actually qualifying for long-term care under the 7702 chassis. Also, the premiums are guaranteed and may be guaranteed for life. So you have a lot more leverage than in traditional long-term care policies where you have no clue where your premium payments are going to be 5, 10, 15, 20 years from now. And as you get older, do we want to spend more or do we want to spend less? Do we want to pay more or do we want to pay less? So with traditional long-term care, the biggest challenge is not knowing whether you're going to be able to afford that premium 20 years down the line at a point in time where you may need that coverage the very, very most. Again, under a 7702 plan, if the insured does not have a need for long-term care, then the death benefit would create a tax-free, and I repeat, tax-free recapture of all premiums paid and much, much more. So in the same example that I just gave you a few minutes ago, if you purchased a 7702 plan with a long-term care or critical illness rider at the age of 55, and you passed away at the age of 85 in your sleep, never needing long-term care, then the death benefit proceeds would be paid to your beneficiaries tax-free, and it would pretty much recover whatever premiums were paid to take care of that potential long-term care liability on your behalf. Now, what if you only used 50% of the benefit? So let's say that you had a $500,000 death benefit policy and you used $250,000 for argument's sake for your personal long-term care. Well, then upon your death, the remaining $250,000 or the remainder will then go to your beneficiaries tax-free. So one of the main reasons why I kind of like the 7702 plan protection more so than traditional long-term care is that in traditional long-term care, if you get what you want, which would be to live a long life and then not wake up one day and not have to deal with long-term care issues and concerns, if you get what you want, it's going to cost you a lot of money. With the 7702 plan, if you get what you want, then there's a tremendous cost tax-free recapture, and most important, there's a death benefit that would be paid to your surviving spouse or beneficiaries from a business perspective. So that's a major, major difference between traditional long-term care and 7702 plans. Now, the other issue and the other difference is that expenses are paid based on indemnity as opposed to reimbursement, which means that if you have a $500,000 7702 plan with a critical illness rider or a long-term care rider, and you choose a 2% distribution rate if you have a need for long-term care in the future, and that 2% distribution rate would be on a monthly basis, then on $500,000 at 2%, that would be $10,000 a month. So once you qualify for long-term care based on the activities of daily living, meaning that you cannot perform two of the 6 activities of daily living, and it has been certified by one of your physicians, then you and your family will start receiving $10,000 a month in order to cover the long-term care benefits. Now, if the cost of long-term care was only $7,000 a month, then obviously your family and you can pocket the difference because you're being paid out a portion of the death benefit to cover the long-term care needs. So you're not going to have to go through reimbursement. You're not going to have to send a bill to the insurance company in order for them to take a look at and figure out what qualifies for long-term care benefit reimbursement and not. You're not going to have to deal with any of that because it would be based on the indemnity, which means that they will pay a percentage of that amount that you chose prior to having a need for long-term care. What I do encourage each and every one of you is to take a look at your long-term care needs and objectives, and make sure that you do that as soon as possible. Make sure that you're able to take a look at the different options that may be available to you and your family. Because the worst thing that can happen to any of us is that all of a sudden we have a need for long-term care. We did not provide proper coverage, and therefore, because of the fact that we did that, now we're going to have to deplete assets at a faster pace than we had intended, and therefore we have unintended consequences that may destroy your surviving spouse's ability to maintain his or her standard of living because of the fact that you failed to do your due diligence at a point in time in your life where you could have done. Again, I wanted to spend a few minutes with you today dealing with this very, very important issue that needs to be paid attention to because it is one of the four major risks. The risk of dying too soon, the risk of living too long, the risk of living with a disability, and then last but not least is the risk of living with eroding factors that we've talked about quite often: taxes, inflation, opportunity cost, stock market volatility, interest rate volatility like we're seeing today in the marketplace. So again, these are things that all of us need to be able to protect ourselves from. And if you have the ability to say to yourself, after you do all the proper planning, that you have protected yourself and your family from those four major risks that I just talked about, then I believe that you have done an outstanding retirement plan, and that you have done the very best that you could in order to mitigate all of those negative circumstances. So again, please don't forget to subscribe to our channel, Your Tax-Free Life, because at the end of the day, we're here to help you each and every day by giving you education that would be so important for the way that you prepare and that your family prepares for retirement. And again, for those of you that may want to reach out to me and ask me any questions, or if you feel that I can provide some benefits by using my expertise and my ability to put all of this together through a tactical retirement blueprint that we do on a regular basis for all of our clients, please feel free to reach out to me at area code 786-766-1042, or you can again email me at Bert, B-E-R-T, at gablestaxgroup.com. And as I always say every single week, my number one goal and that of my firm is to kind of change each and every one of you and to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, have a great week. Have a great weekend, and we'll talk again next week. Take care. Bye-bye.